So, Chris, tell us first about Dream America and what strategy Dream America is involved with regards to capitalism and how you make money for your investors.
Yeah, sure thing. Thanks, Mike. Yeah, so I launched Dream America in 2018 after 25 years on Wall Street, where I worked with a wide variety of institutional investors, corporations, wealthy individuals. And the idea behind Dream America is that we can earn superior risk adjusted returns by helping our tenants become homeowners. So, our program is we buy a house that ultimately our tenants want to buy, so you can almost think of us as a type of bridge lender, except that we're not a lender, we're the asset owner. We own the house, they rent it, they have the option to buy it back as soon as they're mortgage ready. And a key component of our program and what allows us to earn a premium rent is that we help them get mortgage ready. So our underwriting and process is designed to help the tenant succeed. And in fact, over the last 5 years, 75% of our sales have been to our tenants, which I think shows the program has worked.
All right. So, Chris, you're helping people get into homes. How how is that ESG qualified?
Yeah, so when I started sort of researching different opportunities, I wasn't looking for ESG. ESG, as you know, and you probably discussed in the last group, is something that's really come about more recently. When I started on Wall Street in '92, it didn't exist. It was never a term I heard. I never remember speaking to an investor who was interested in that. There might have been a few socially focused funds, but it was really a niche. It's grown much more recently. So that I wasn't looking for ESG per se. I was looking for an interesting opportunity in the financing space that was not overly crowded, which most of them are. And that's how I sort of stumbled into this rent to own space. However, as I got into it deeper and deeper, and as we've been operating this business the last 5 years, what we've seen is that the vast majority of our clients are coming from groups that are historically underrepresented in home ownership in the US. So statistically, it is much more likely that you're going to be declined for a mortgage loan if you're not white in the U.S. That's just the truth, and this is why every lender has to gather. Banks hate this fact, and that's why they have to gather on their loan applications demographics about the borrowers, because this has been proven to be the case. So we're getting a lot of people that would traditionally be turned away by lenders and helping them become homeowners. So I guess to believe that we are an ESG investment, that we're social impact investment, you have to believe that homeownership is a good thing. I do believe that. I do believe that the best wealth creation opportunity for the average American is to become a homeowner. Somebody who is a lifetime homeowner, or who becomes a owner of a little bit more of the equity in their home each month, is going to retire with a significant financial asset, whereas the average lifetime renter is going to retire with no financial asset. So that's, to me, that's a huge difference in terms of creating wealth for the homeowner, and also something that can be left for future generations.
So, during the last discussion, right, we had an oil man, a developer, a registered investment advisor, a securities litigator, um, and I'm not sure who I'm missing here. But at least those four, and maybe did I say spiritual leader?
No, you didn't.
Okay, so spiritual leader, security litigator, RIA, developer, Texas oil guy, right? So,
And a
um,
fitness guru, Mike. You were on the call.
fitness guru, far from it, and just so everybody knows, I'm not a fitness guru, but I do enjoy working out, and I'm involved in that stuff. So, um, the discussion, basically, if I had to summarize it, it there's no rule book to
Correct.
what ESG really is.
That's right.
So, at Dream America, can you concisely tell us how Dream America is an ESG qualified investment?
Yes, so I'm sure the last panel got into, the lack of a framework, but there are certain frameworks out there. Like the UN has a framework for ESG, and I think there's 19 different categories. And we check a couple of those boxes in terms of, access to the financial system. I mentioned we're helping people who traditionally may be turned away by banks to, kind of break through that system, and I could talk about that a little bit more in a minute. And we're helping people ultimately take control of their financial destiny, if you will. So to me, that is making a positive impact. Let me put it this way, Mike. The 25 years that I spent on Wall Street, I had a wide variety of clients. We did a lot of transactions. No one ever called me and said, "You've made a difference in my life." Now we get that call all the time. So whether you want to call that impact investing or not, it definitely feels good on our side, and we see it because what we're dealing with every day is that the average American, it's not that they're dumb, it's just financial literacy is not taught in the schools. And so people graduate, they go into the workforce, even if they have a college degree, they probably know very little about how their credit score works, but that's going to have a huge impact in their life on their access to credit. Whether they're going to get the attractive rate on a car loan that you might see advertised online, or something much higher because they have a lower FICO score. So an important component of what we're doing within our program, even for the people that we don't put in a house, is financial literacy. If you go online and look at our reviews, they're substantially, overwhelmingly positive, which is unique for somebody in the financial services space. If you look at most financial services reviews, people hate banks. People don't like financial service providers. How is it that we've been able to achieve that? It's because that everybody that we decline, and we decline a lot more people than we accept, we try to leave them with one or two takeaways. So rather than, you're declined, you suck, go away, which is basically what banks do to you. If you've ever seen an adverse action letter from a bank, we say, hey, we can't approve you today, but if you could work on A, B, and C, we may be able to give you a different answer in 90 days, 6 months, when you file your tax return, some concrete event and concrete steps. And we've had a number of people that have initially been declined and then later have taken our advice and come back and been approved for our program, or who call us later and say, hey, guess what? I got approved for a mortgage. Like, I did what you said. I don't need you guys now. I got a mortgage on my own. Again, that's just, an added benefit that we're throwing out there into society. We don't get paid for that. The way that we earn our returns is when we actually put somebody in a house and then help them purchase that home. We collect rent from them and we charge a premium rent. We collect an upfront fee, and then we get a markup on the home. And so when we add all of those things together, we can generate a very attractive return for our investors. And the best outcome for our investors is when the tenant buys the home. So we've got a perfect alignment of interests. People are coming to us saying, I want to buy a home. Our best return is when they succeed in their goal.
So Teresa called it factors. She discussed it in terms of factors. So your company, I guess the factor is, or one of the factors that can be considered, is getting somebody in a home so that they're not left out of the wealth creation and accumulation um, process that we have in our society today. By owning a home, the home is going to appreciate over time, and you're helping people that can't go the traditional route to get into the home that they want to own and then eventually own it. So, in essence, your impact score could come much later in their lives, like when their house is appreciated and they've paid off their 30-year mortgage and they now are sitting on an asset, instead of having to pay a liability each and every single month. So that would be one factor, right? So now an investor thinking about Dream and making an investment into Dream, they would be, not only earning a good return and doing, well by investing with you, they would be helping people that might not have the opportunity to participate in the appreciation of home ownerships of their home and retire someday. What other ideas do you have? What other ideas do you have in regards to factors in how Dream is an ESG qualified investment decision?
Yeah, I know that there's 19 of them, but I don't have all the factors memorized. But I know that financial access and financial literacy are two of them because in any economy, whether it's an underdeveloped economy or a well-developed economy like the US, if you're shut out of the banking system, you're going to have a really hard time succeeding, in that economy. And so we're dealing with people that may not be completely shut out. The way that it works in the US is you may still have access to credit. You may just have it, as I mentioned before, at a much higher cost. So an important part of what we're doing is arming people with the information that they need, to make decisions that are going to lead to a better financial outcome, which goes beyond just what they're going to do, in terms of buying a house. It's going to help them the rest of their lives in terms of having a high credit score. And there's no downside to a high credit score. whether whether you're going to be an active borrower or not, having a high credit score is only going to help you. And that's the first thing that we do with everybody that's coming to us is help them get control over that. Then over time, for the people who are in one of our homes, it's not like we just put them in a house and say, you could buy it, good luck doing it. We're actively helping them throughout the life of their lease, right through the moment when they finish their mortgage and buy the home. So every one of our tenants that's buying a home, we're not only working with them, we're also working directly with their lender to help make sure that they get the best possible, deal and treatment, if you will, on the back end. Which again, for people who are on the call, you're financially sophisticated. You might be, hey, that's really easy. I can just do that on my own. I go online, I go on Bankrate, I can see who has the best rate. What we found with the mortgage system, though, is that the lenders advertise based on rate. And if you've got great credit, clearly you want to find the person with the lowest rate. That's an easy point of comparison. But if you have marginal credit, like you could qualify for a mortgage, but you might also be declined, then there are other factors that become more important than rate. For example, is the lender adding underwriting criteria on top of what the government requires? So for an FHA or VA loan, those are federally backed loans, federally insured. The government sets the minimum underwriting standard, but they allow lenders to add extra hurdles or hoops on top of that, which they do not have to disclose to consumers. So the consumer has no way of knowing unless they know what questions to ask. But if you're not a lender, you don't deal with this, how would you know what questions to ask? They have no way of comparing one lender to the other than rate. They may also be able to get a mortgage that is generating a credit for them up front that they're using towards closing costs. Again, that's maybe a hard thing to compare from one lender to another. So we're actually acting as a kind of financial advisor to our tenant through that entire process to help them navigate it and hopefully come out the other side a homeowner. And this is a benefit that we don't overly advertise on the front end because it's hard to understand. It's very tangible for someone to understand. You're putting me in a house and you say you're going to help me buy it. And I can look at your reviews and history and see that you've done that with a bunch of other people. It's hard for them to fully appreciate what we're doing on the back end in terms of navigating this potential morass with different lenders when they're trying to get a mortgage and are right on the cusp of being able to qualify.
So they can be a part of the American dream.
Well, that's right. I mean, that's there's the name, Dream America, American Dream. But that's right. Look, it's being a homeowner. We all know that home prices have had significant appreciation over the last, pick whatever the time frame is, 10 years, 20 years, 30 years. But even if you think home prices are going to flatline for the next 30 years, A 30-year mortgage is a forced savings program because you're paying a little bit of principal and interest each month, and the portion of principal you're paying is growing over time. And a lot of people, what we see with our clients is have a hard time savings. And that's why I'm saying, if nothing else, even if the home didn't appreciate, they'll have tucked away a few $100,000 by the time this loan is fully paid off, which is huge. That's a game changer.
Especially later in life when a lot of seniors are thinking about like not having enough money to
Right.
finish their lives.
You're going to live on a fixed income. You're going to live on Social Security. Very difficult. And if you're a renter, obviously the other thing that you're subject to is rising rents. When
So,
you're a homeowner, you know what your payment is going to be for as long as you're there, as long as you're making those payments.
I think this part is interesting because in the last debate you know, we had five people, just like five people talking, five diverse backgrounds. We only had an hour. We went an hour and a half, and we're scratching like the surface of things. Um, but it's already been agreed that the American dream is the American dream, right? Like that is a universal like truth in our country. That's why it's called the American dream. So is it fair to say that is it it's definitely over 50% would agree with that statement? 50% of Americans agree that home ownership is an American dream. Is that fair to say?
Yeah, it is. And look, there's a counter school of thought, and this has caught on in the media over whatever the last 5 years. The idea that people don't want to be homeowners, they want to rent, and all these rental companies have sort of sprung up to service that. And there probably are people who feel like that. Look, if you're moving to a community and you're not sure if you're staying, you probably don't want to be a homeowner because there's going to be friction costs in buying and selling a home. And so there's definitely going to be a proportion. If you're earlier in your life, you're single, you probably don't want to be bothered with the house. You come home to an apartment, go out with your friends, have fun. Who wants to bother with taking care of a house? I get that. But if you look at the demographics, as the population ages, as people get to the point where they're, forming households, having children, they want to be homeowners. Now, maybe they won't be able to be homeowners, and so they'll be forced to rent a house. And there's obviously a bunch of companies that are, sprung up and that are servicing that. That doesn't mean that they don't want to be homeowners. And the government has been promoting home ownership for a long period of time. That's why we have these mortgage programs. FHA, 3.5% down payment, 30-year mortgage, open to everyone. VA for our vets, zero down, again, a 30-year mortgage. These are phenomenal programs that have made home ownership accessible to many Americans who otherwise would never be able to get together a 20% down payment. So kudos to the US government for developing those programs and promoting those programs. And really the way we think of ourselves is we're a feeder into those programs, because to get into them you still have to get through these requirements. And like I said, those requirements may vary by individual lenders. You may go to a lender and get rejected and not really have a clear path as to how to get a different answer in the future. And it's not that the loan officer couldn't explain it to you. The question is, will they take the time to give you that game plan, or are they just on to the next person who is qualified and they're just processing loans, and and they don't take the time and to do that. And I've seen both loan officers. I've seen ones that are just focused on who's approved, and we've seen ones that do take the time to help people out. And we're really in that bucket of working with those lenders that are servicing clients that are kind of hovering around the hoop, like they're on a path and they will be able to qualify for an FHA or VA mortgage, but they may need a helping hand to get over the hump. That's who we're really looking for. So it's not that we're saying homeownership is right for everyone or that everyone should be a homeowner. We're trying to find this group, and this is a group that we've studied. This is millions of people nationwide in major metro areas that are renting, would be interested in homeownership, and they're kind of on this cusp, but they need a helping hand to get over the hump. That's who we're really looking to tap into. We're not selling home ownership. If somebody comes to us and they're like, I don't know if I want to be a homeowner, we say, we're great, go rent. We're not for you. were for people who've already decided, I want to be a homeowner. I tried the renting and waiting and figuring it out on my own. Like I've been doing that for years and it hasn't worked. I'm still renting and my friends became homeowners. So I'd like some help. That is who we're looking for. And that is a huge audience.
So, interestingly enough, Chris, there is um, a study. There's a little study that's out there, or a survey rather, and that survey has um, some interesting details, which I am going to project onto the screen here and add it. It's from Bankrate. Um, so I took away your picture, but people can hear, and this is a really bad. It's a bad image that I clipped, but let me do it a different way. How's that? All right, here we go. It says the survey released in March for Bankrate.com, a financial services company, found that 74% of respondents ranked homeownership as the highest gauge of prosperity, above having a career, which was ranked at 60%, having children at 40%. Sorry for the children out there. And a college education at 35%. So, my comment that it's as close to as universally like accepted, um, like common dream, common aspiration is being backed up in this survey. Um, so, Dream America is helping those that don't have access to credit pursue the dream. So, I would say as a factor, like if we it would have been interesting to have Teresa on here and hear her opinion as far as how she would rank Dream America from an ESG perspective. And I think that you could make a very strong case based on looking at it from this point of view that this is a like true ESG investment. Not trying to sell you.
Yeah, look, I'll give you both. I'll give you both. I'll give you both sides of it. I'm gonna want. I want to say two things. I want to make one point on this access to credit because I don't want to. I would say when I started Dream America, coming off of Wall Street, I didn't deal with consumers on Wall Street. I dealt with institutions, et cetera. So I didn't know anyone with bad credit. And if you would ask me in 2018 when I started, what do I think about people with bad credit? I'd say these are people who make bad choices. Right? They overextended themselves, and so they have bad credit. And there's definitely an element of that. And that's part of what we're trying to do in our screening process and underwriting is weed those people out because that can be hard to change those bad decisions. So who are the people with bad credit that didn't make bad decisions? There's lots of them. And one that we see all the time is single mothers. People get divorced, assets get divided up. Say the husband gets the car in the divorce, but they'd co-signed for the car at the time it was bought, and then he stopped making payments. Guess what happens? The wife's credit goes down the drain. And she says, but he got the car in the divorce. The note holder says, I don't care. You signed the note. We see that one every day. Did she make bad decisions? Maybe she married the wrong guy, but she didn't make bad decisions. It's just being caught in a bad situation due to the way the financial markets work. Also, just think about, a car accident. I don't want to be in a car accident. Michael doesn't want to be in a car accident. None of you do. But if I was in a car accident, it's not going to wreck my finances. For many of our clients, it will, though, because if they can't work, they don't have unpaid leave. They're not going to be able to keep up with their regular bills. Now they got new bills on top of it. Maybe the car's destroyed. They don't have gap insurance. So now the lender is saying you owe me more than the insurance company is willing to pay. Again, this isn't someone who made a bad decision. They're just caught in a bad situation. So we see these profiles all the time. And not that we like people to be in unfortunate situations, but on one hand, we do like this because these are things we can help. We're not trying to change someone's behavior here. We're just trying to say something happened to you, it's behind you, but you've got income, you've got cash, and we can map out a plan for you and get you on track to be a homeowner. So that's the piece that I just want to say about access to to credit and how all that works.
So you're very focused on access to credit. That
Yeah.
sounds to me like the what you're solving for from an ESG perspective. Um, so what do you think about um, the specific details of how you structure your transactions with the person buying the home? How do you balance um, the capitalistic side? You are a profit corporation.
Yeah, we're
You're
for profit company. So
you're a
that's I
fund.
so I so I told you I was going to give you the flip side. So somebody want to be a critic of what they're doing, they would say you're overcharging people. You're taking advantage of people in a bad situation and you're overcharging them. None of the banks are willing to help them, so I'm not sure how we're, overcharging or taking advantage. We're setting a market. We're setting a price for a type of credit extension. It's not coming through a loan. It's coming through a lease with an option to buy, but it is still a form of credit extension. Um, but we're doing that for somebody who, like I said, couldn't qualify for a conventional mortgage. So guess what? It's more expensive than a mortgage. And to me, an important part of offering a financial product, whether you're offering that to someone who's sophisticated or to a consumer who doesn't have a background in finance, is disclosure. You need to tell people up front. And so we do. The calculator for our rent is on our website. We only have a few competitors, but go to their website. You're not going to find a rent calculator. So we're telling people up front. They could go and look on our website at homes that are there. They could go look on Zillow, find any house, put the numbers into our rent calculator. They'll know exactly what their payments are going to be. And so I would say to that critique, which isn't totally unfair, but I would say, price is what you pay and value is what you get. I think I'm taking that from Warren Buffett. And the value, if people succeed in our program, the value that they're getting is immense because we're helping them break through this barrier that they may have bumped into for years, for decades, for who knows how long. Our clients are not 20 somethings. Our clients in their 30s, 40s, 50s. I mean, their average home buying age in the U.S. is in the 40s. So these are not kids that are trying to figure out how banking works. These are adults that have been in their jobs for a long period of time. They're dealing with life. They've got, generally they have families. We're not getting a lot of single people coming to us, and they they need some help. Like I said, navigating this process and achieving the dream that they've already decided on, which is they don't want to be, a renter and have their rent go up every year, or have the landlord say, "Oh, I'm selling the house, so you got to move." Like they want the stability and opportunity for economic growth that comes with being a homeowner. So yes, there are costs with our program. There's this premium rent that's paying, the fee that you're paying to join, but we really emphasize getting people through the program as quickly as possible. And this is the main thing that sets us apart from the couple competitors that we have that try to string people out for years at a time. We, in all of our options, we give people a 6-month option, and we do our best to push people through in 6 months, which can be difficult. A lot of people need the year, and they may need more, and that's okay. But we tell them up front, this is more expensive than a loan. Like you've already put money down towards your down payment. You're living in the house that you wanna own. We've given you the game plan. You know what you need to do. So let's not dilly dally. Let's not, make bad decisions and drag this out for a year or 2 or 3 years. Like let's try to power through. And the people that we have that come in that are really focused on that, they do it. They do it regularly. I mean, we've had people buy from us in as little as a couple of months. It's an extreme example, but we have. And so we're encouraging that, which is fundamentally different than, you know, others and other landlords that just want you to rent year after year after year. We don't want to do that. And that's why we have to decline a lot more people than we accept, because when we see a profile where there's a lot of moving pieces and we're like, oh, it's probably not going to happen in a year. It's probably more like 2 or 3, or, you know, who knows, because there's just too many unknowns. That's the profile that we're going to decline and tell them we're declining you, but we could give you a better answer in the future if you did A, B, or C. In other words, start to take those steps to narrow down those moving pieces so there's real clarity, so that we can be confident when you come in, there's a path to get there over the course of the year. And the reason why, you know, I say a year, Mike, I think of us almost like think of it like a financial weight loss program. If I came to you and said, I got a program for you to lose weight, you've already done it, so you got nothing to lose at this point. But I got a plan for you, and it's a 3-year plan. Well, what do you do in the first year? I don't do anything. Like, there's no urgency. If I come to you and I've got a plan, I'm like, we got to get this done in the next 6 months. If you're motivated, you're going to be focused on doing that. And that's really the way that we approach this. We don't want a really long period of time, because then there's just too many factors in people's lives that can get in the way. We want to push them through our program and convert them into a homeowner as quickly as possible. And to me, that is the overriding most important thing that we do from a social impact standpoint, is not tie people up in the program forever. It's push them through it as fast as we can.
So if I was conducting due diligence on you and doing thorough research on Dream America and um, what looking at it from the perspective of am I making an ESG investment? Um, how how would I go about doing that? Do you have some certification? Did you apply for any certification? Have you thought about going through any particular process to? Uh, is there a stamp of approval out there? I guess.
So we have an institutional investor, and that's an ESG fund. It's called Variant Investments, and you can look at their impact report, and we're mentioned in it. So I'm not telling you anything that's not public. They're an interval fund, so it's a fund that's registered with the SEC. And what do they look at? They look at some of the things that we've talked about here. What is the demographics of our clients? So we don't collect demographics on our applicants, because I don't want people to feel like that's part of the application decision. It's not. We don't really know the demographics of our clients until they're actually moving into houses. But they track that over time and see how that is, and they'll see that, as I mentioned before, the majority of our clients are minorities, the majority are African American, and the majority of the clients are women. Like I said, we have a lot of single mothers in the program, and then they look at our success rate over time, which, like I said, the majority, well more than the majority of our sales have been to our tenants. And even on the houses that we didn't sell to tenants, it's not like that other 25% of people failed. A lot of those wound up becoming homeowners, just not with the home they were renting from us. You might say, well, why was that? Well, come back to what I just said a minute ago. We have a lot of single mothers. So guess what? Some of them get remarried. They need a different house. And so they come back to us and say, Chris, thanks for helping us. We've got our mortgage approval, but we don't want to buy this house. We need a different house for our family. And so they go off and buy a different house. We resell the house. Maybe we put it in another client and or resell it on the open market. We've done very well in those homes as well for the investors. So it's not like the investors have lost out. So it's still a win-win for the parties involved. But like I said, we've had a very overall high level of success in terms of people achieving their goal and getting a mortgage and becoming a homeowner.
All right. So that's interesting. That was another thing that came up on our last little discussion, is how Jeremy didn't believe that minorities would be included in the writing the rule book for ESG, because it's not a topic that's debated in the Black community, And interestingly enough, that's the concentration of your client base. And I really like what you had to say about how the institutional investor does a report on you before making their investment. Um, that's very interesting to me as well. That would be a nice box to check. Um, is there an organization out there that certifies investments as ESG certified?
Well, there's probably multiple organizations that do it, but it's not something that we've dug into. I mean, the way that we've approached it, we've talked to a number of ESG investors, and even the individuals that are invested in our funds. I would say, some of them are just interested in the returns, but most of them are interested in the return plus the social impact. Um, and so we've really let each investor do their kind of own due diligence and provide them with whatever information we can in terms of how the business is run and what our objectives are, and then what we've actually been able to do since, as I said, we've been at it now for 5 years. So there's, this is more than just an idea on a whiteboard. We've been doing it. It's been working in a variety of different environments. The program is not designed for a specific environment like a good housing market or a bad housing market. It's just designed to be able to, perform in a variety of different markets.
All right, let's switch gears for a second here. Get off ESG. Go back to Wall Street. Um, Talk to me about the performance of making an investment inside of Dream America. What do the returns look like, uh, hypothetically?
Yeah, so the returns have been low teens. We target 10 to 12% in terms of annual distributions to investors. And so we're distributing the rents that we collect, the onboarding fees, and any gain on sale from the houses that we're selling each quarter to our investors. So that's the distribution yield that I'm referring to. And obviously, the investors accruing gains in these other houses, which will be sold in the future. Um, why do I say that is an attractive risk-adjusted return? Because there are higher returns in real estate, right? Look at development deals; they're going to have higher returns than that, or they're not going to get funded. When um, when we buy a house, we're buying it for a specific individual. So we're onboarding the individual. They're going out in the communities we're active in. They're picking the house that they want that meets our property criteria, and it's in the cities we're active in. So there are limitations on it, and it's obviously within the budget that we've given them. Um, but because of that acquisition process, if we buy a house today, we start collecting rent today. And in a typical scenario, the client moves in today, they start paying rent today. Um, they are responsible for routine maintenance items on the home. So if there's a leak under the sink, or you got to deal with the toilet. They're not calling Dream America, they're calling the home warranty company. So all the houses have a warranty on them. They're really in this home ownership mentality from day one. And then at some point in the future, they buy that house directly from us. So if that scenario, which is that is our goal, and that's what happens in many cases, if that plays out as we intend, well, what does that mean for investors? It means there's no vacancy, no leasing, and no maintenance costs. Well, those are the three things that grind down investors in single family and multifamily. What are the vacancy rates? What's the turnover? What are the leasing costs? Because for a typical investor, they're buying houses that are probably vacant. They're spending some money rehabbing them. They're spending money leasing them. Then they put a tenant in, and their best case scenario is that tenant pays the rent that they're supposed to, and they renew at a higher rent. That's the best outcome that they're going to get. If not, they're doing all of that all over again. More rehab, more vacancy, more leasing costs. So we're cutting that out, and so it's a low risk investment for the investor because of the way that we run the program. And the investor that's typically attracted us is someone who's looking for that income. So they like those quarterly distributions. And the rent that we're charging, as I mentioned before, is a premium. So we're typically we're typically pricing in a 9+ cap rate, whereas a typical SFR might be 4 to 6%. So we're getting that. And why are we getting a premium rent? Well, we're getting a premium rent because really they're paying again for more than rent. They're actually paying for a service. So real estate is what we're using, but we're providing a service to these clients, which is helping them become a homeowner. So yes, it's a higher rent, but hopefully it's only a higher rent for a short period of time, and then they become, the homeowner.
So, Chris, I am showing the registration page for today's event. I'm not sure if you can see that on your computer,
Hmm.
but we have a marketplace listing,
Yeah.
the Dream America Fund, and we have some materials. We have some information about your background, your bios in here. So if people want to see your bio, you had a very successful career in Wall Street, senior guy. Um, how big do you want to grow Dream America? How scalable is your fund? Like, how much capital could you bring into this strategy realistically?
Yeah, so right now we're small. We've got 35 million at homes. Um, we could easily deploy a few hundred million, 300 million. Is this something? The demand is much bigger, but obviously that entails building a much more complex operation. If we said we wanted to deploy billions of capital, so for us, we'd like to be bigger than we are now because there's a lot of demand in the markets that we're active in that we're not able to meet today because we just don't have the capital to do it. So that's another reason we have to turn away more people than we accept. We don't have the capital to fund all the deals that come in the door each month. I mean, we organically get 1,000 to 1,500 applications a month with virtually no advertising done by us. And this is because we have a network that we've built up of 5,000 real estate agents in the markets that we're active in, and they're sending clients into us each day. And so that acts as a natural way for people to get into the program. So there's a lot of demand for this. But if you just said the average house is $250,000, and tomorrow we had $1 billion, that's only 4,000 houses. The largest player in this space, there's one big player, Home Partners, who Blackstone purchased. They have over 2,000 houses just in Atlanta, which is a key market for us as well. So the issue is not one of sizing and market opportunity. It's more just a matter of running the business. We're organized as a fund, but at the end of the day, this is very much an operating business that we're running day to day, bringing these applications in, underwriting them, putting people into homes, helping them through the program. Um, but with the technology that we've developed over the past few years, it is very scalable. We're able to handle a much higher volume than we have today if we've got the capital to put those people in through and into homes.
So anybody that's listening, you come to the site, you go to the marketplace, you search for the Dream America Fund on the marketplace, and then you can get a hold of Chris by just clicking the Invest Now button, and it brings you right over to the Dream America, site, and you can learn more about the success that Chris has had helping people who don't have access to credit get into the American dream. And it's definitely, the absolute, I guess, most agreed upon. Uh, what would the terminology that I'm looking for be? It's the most agreed upon dream in America is home ownership. More important than career, more important than having a baby, and more important than, I forget what the third thing was in that survey, but it ranked at the top of the list for prosperity. So if you're looking for somebody who does have a concrete way for you and your investments to make a difference in the world, contact Chris. I just showed you how. I'll be sending around the recording of today's presentation. And Chris, we got to get your materials updated on our website.
We'll do it.
That's my fault. So
No, it's probably
um,
mine.
I'll get the materials updated so that you all have access to the most up to date presentation and numbers. But um, to reach them, you can just go to the marketplace, type in Dream America in the search, and Chris will pop. Uh, he'll pop up here. Just click Learn More, and then if you want to look around, you can look around and understand more about what we talked about today. Chris, thank you for coming in. Thank you for being a part of Flyer. We appreciate, we appreciate you. I appreciate you, and I really love what you're doing. And the more I think about it, the more I think about, like, in the last conversation, reflect on the last conversation. I think it was great having you on today, because there's a lot of people that are misrepresenting, but an ESG related investment, and they're doing it for marketing purposes. And there's nothing ESG about what they're offering. And with you, that's definitely not, it's not the case. So thank you for giving us a concrete example of how Dream America is making a difference in the world today, in lives of those, um, you know, least cared about. You talked about your experience on Wall Street and how nobody ever thanked you, and for making a difference in their lives. Um,
A positive difference. Sometimes
a,
people call and yell at you.
a positive difference in their lives. But the Dream America is making a difference, a positive difference, and people are, like, thanking you for the help that you're providing them. So, thank you for being a part of our community. Thank you for coming on today. I look forward to having you back soon.
Great. Thanks, Mike.
All right. Bye now.